Well, welcome everyone to tonight's asset protection webinar. We are delighted to have Mike Coval back with us. There is so much uncertainty right now in the market, in the economy, in just in our world, but certainly in our nation. The news is the media feeds into it, and if you just listen to that and spend so much time, I heard a really good reporter saying how to reduce stress in this time. Says turn on a really good, reliable source for about 20 minutes a day and then turn it off. And I just thought that was brilliant. So we're so delighted to have Mike and talk about what's happening with the economy. I don't know anybody that's more in tune to what's happening than Mike. Mike, we are so delighted to have you. But before we do, there's a couple little announcements that I kind of need to make, and going forward. As most of you know, this is part of an overall webinar package. We had Scott Estel a few weeks back. We had Gene Guarino, attorney Robert Bloom, Mike Coval, obviously tonight. Next week, we've got a really special treat. Attorney Toby Mathis from the Anderson Law Group will be here talking about how to benefit from the brand new CARES Act. He has studied it. He's been a nationwide speaker on the subject. He's been back to Washington to meet with several media groups. He's become really quite the expert on how to benefit, how you can benefit from the CARES Act. Travis Howard coming on the week after that. And then I'll be speaking on some basics of asset protection that we tend to overlook on April 28th. So we invite you to attend those as much as you can in the future. We also, as most of you know, we were planning on doing the Phoenix event at the end of April. And this is just absolutely wrong. So I'm going to change that while you're right here in front of you. That is, there we go. The Phoenix event was April 27th, 28th, 29th, and we moved it magically to July, the same dates, 27th, 28th, 29th. Our concern is that we still have over 250 people registered for that. We've sent out emails, we've started making phone calls, and my concern is that if you show up there, we're not going to be there. And we're trying our very best to get the word out. But if you have reservations, we're trying to get you booked into another event, either Anaheim, Phoenix, or Orlando. And our other concern is we still have a huge room block with the hotel. And according to that report, a lot of you haven't canceled your reservations. And so just because you canceled with us or we moved the date to a different date doesn't mean that the hotel won't hold you to that contract unless you cancel it. So please cancel your airline trips and cancel your hotel reservations because we won't be there at the end of April. That's too soon, as all of you recognize the reasons why. That's, again, this is where we do we bring in all the experts. Mike will be there at our upcoming summits. If you'd like a sample agenda of what we'll be covering, that's available on our website at protectwealth.com. And we still are moving ahead with the cruise. We're not actively promoting it, but we're also, we still, there's so much uncertainty that we haven't canceled it. For those of you who have booked on the cruise or would like to book, we're still taking reservations, and we have a 100% refund policy up until August 1st. And by that time, we can hopefully make a decision whether to go ahead or whether to postpone it or cancel the cruise. So we're looking forward to it. We've had so many great experiences on cruise ships where it's just really good one-on-one time with the instructors and the attorneys that are there. And I can't think of a better teaching opportunity or learning opportunity than on those cruise ships. So we're still kind of in wait and see mode, but we are proceeding. And anyway, let's move forward. So for tonight, before any of our webinars, as most of you know, we don't do earnings claims. We don't teach, we don't give legal advice. We don't give tax advice. We try to give really good sound principles and then encourage you to seek an investment advisor or a tax advisor and an attorney before you moving forward. So with that, Mike, I get so many people that on a daily basis that are calling the hotline that are concerned about this and concerned about that, and I love the piece that you just speak, and I agree that if you're prepared, you don't need to fear. So teach us what's happening in the market and how maybe we can benefit from this. Mike, again, thank you very much for being here and sharing with our students this evening.
Well, thank you. And by the way, I'd like to say I really appreciate the fact that you have my picture from when I was 22 years old on there. I just love that. It's a great picture in my
I thought you were 24, but who knows? There you go, Mike.
So just doing a recording here for it, so just in case we lose it any place. So let's go ahead and get started. My name is Mike Coval. I'm really happy to have everybody on here. It looks like we've got quite a few people here. It's actually kind of neat to have everybody. I wasn't expecting to be quite that big, but we'll take it. I got to just move, so I'm trying to get it across the screen here. Here's kind of my agenda with where I'm going with tonight, and I'm going to cover this in detail. So first, as I was speaking before everybody hopped on the call tonight with both Don and Kendall, I'm really happy you guys are here because sometimes I do forget that not everybody's in the stock market and you don't know what's happening. And there's a lot of fear and panic out in our economy. Am I going to have a job? Is my company going to go bankrupt? Am I going to be able to make my house payment? What's going to happen through here? Are we going to have any kind of a bounce? We're going to sell off more. And sometimes I forget that not everybody understands that because I'm in it every day. It's what I do for a living 24/7. So I'm going to give you some feedback where I think we're going to go, what's coming up next, how to prepare for that. Probably what's going to happen inside of your accounts and some things you can do, what your brokerage firms will not do for you, and so what kind of guidance you're going to have to give them going forward, and kind of what to expect, and then also maybe a little bit how to actually profit from some of what's going on as well. So first thing I want to do is just kind of give a real quick update here, and I do want to keep this kind of participatory, so if you do have a question while I'm going through this and you want to just kind of ask it, go ahead, and we can take it from there. So number one, the selling is not over yet. We had a bad marketplace. Obviously, if I just go back, I'm just going to pull up a chart. I'm on my website, which is incometrader.com. But I'm just going to pull up this chart of the S&P 500. This is the benchmark for the U.S. marketplace. I'm just assuming that most of you who are on here, because it's a financial webinar tonight, are probably already in the stock market in some way, shape, or form through an IRA or through some mutual funds or pension plans, 401k, something like that. So I'm not going to be too extensive, but I'm not going to be really basic either. I'm just going to assume that most of you understand that if I look at the S&P 500, that's the benchmark for the marketplace. It's 500 of North America's largest companies. But if I pull up a chart, we can just kind of go back and see, and here's a 6-month chart. This was 5 months in a row, just kind of coming through here, where we went straight up. It was a nice little trend, with a little pullback right in through here, but went up. And then we just had our largest massive sell-off here in multiple generations. I mean, you got to go back almost 70 years before you saw another sell-off like what we had here in 3 weeks. And we think about this, the coronavirus, the entire world economy, not just our economy, world economy got shut down in 3 weeks. That's as bad as it's ever been. I mean, it goes all the way back to, the Great Depression, 1930s. So we had this huge sell-off coming through here, and this is all about, okay, people are afraid, am I going to lose my job? Well, you're not going to have to go to work. California starts off with, we're closing everything that's not mandatory. Then New York goes, and other states go through to where, you can't go to work unless you're an essential type of a business. And we think about all the people that got laid off. And so we had just huge, massive selling here. And this is just as bad as it gets. I mean, if I go back here and let's just pull up, a 3-year chart, and we just go back and look at the 3-year chart. Big moves back here, but nothing like we had over right in through here. This is just as bad as many of you in your lifetime has ever seen, and hopefully will ever see. But here's where I want to go back and just kind of cover. This all happened because we didn't know what was going on. Everybody was fearful and panicked, and the stock market drops much faster than it ever goes up. So because we had such fear and panic, nobody knew what was going to happen. All businesses shut down. The stock market just tanked, and there was just a lot of negativity, and then people started selling things short, and then the computers kicked in. And when the computers kicked in, these are just automatic algorithms that say if we ever drop so much, start selling everything and just dumping and dumping and dumping, which causes even more snowball effect to the downside. So that's done. that part of the selling we just had here is done. And that was right back here. We'll just go back to a 6-month chart. And that was right back in through here through end of March through the middle of April. This was our big selling section right down and through here. This huge heavy selling that we have with these big huge down days we had, market down days, everybody wants you to know that's done. The panic is over. We now have a grasp of what's happening. We know we're working on antidotes. We know that we're working on things to fix this. That huge market sell we had is done. But all that means is that the initial selling is done. Now we're going to get back into what's going to happen next. And what's going to happen next isn't really going to be that pretty for us. So I want you to know that the selling isn't over. The heavy selling is done. But now all of these companies that were supposed to be making a profit because we had a really strong economy aren't going to make that profit going forward. You've got people who aren't going to get hired again when everything goes back to work. You've got people who are going to lose their jobs. You've got other companies that even when we do open back up, there's still going to be people that are afraid to go back to work, or they're going to be afraid to go out in public. They're going to be afraid to go shopping. They're going to be afraid to go to a sporting event, and it's going to hurt the economy. And it's going to probably take about 2 years before that comes back to normal. So what that means is there some people here? Can you guys hear the audio as we're coming through this? If you can hear audio here, go ahead and hit yes, please.
Sounds good on my end too.
Yeah, okay, well, I got a couple people saying no audio. Okay, just, you know, I want to make sure. Okay, good, thanks, guys. All right, so now I just want you to understand that it's going to take about 2 years for our economy to come back to normal, guys. And so with that, it's going to be slow going. And so we're going to enter into what's called a recession. And all a recession simply means we have 2 quarters in a row of negative GDP growth. That's all that it means. It's not going to be bad. It's not going to be as bad as we just had, as I just kind of pull up this. It won't be this bad, but we're going to see probably something like this. It goes up a little bit, it'll drop, it'll go up a little bit, but it'll be slower and it'll be manageable. But we are going to still head to the downside. We're going to see lower lows. If you've got a 401k, it's going to be lower. By the way, I wasn't saying this 6 weeks ago. 6 weeks ago, I was saying we got a fantastic economy, but nobody knew the whole world was going to shut down in 3 weeks. So if you got a 401k, it's going to go lower. If you've got an IRA, it's going to go lower. And the reason for that, the people that are managing your money right now are putting you into mutual funds. And by law, mutual funds have to be, the majority of all funds have to be invested at all times. So if they're invested in the stock market drops, where are your funds going to go? And so by default, your funds are going to go lower, your IRA is going to drop, unless you know what you can do to fix that. We're going to cover some of that, but I just want you to know the mutual fund managers will be hitting losses, all of them, and be very few of them that are making a profit because they're going to be invested in the biggest companies out there. If I'm managing let's say a $3 trillion fund, $3 trillion, do you think I'm buying shares of stock that only trade 100,000 shares a day? No, I'm buying shares of stock that trade 30 million shares a day because I have to buy that many. And there's over 36,000 equity mutual funds in the US. There's over 50,000 total when you get to dividend bond funds and some of the other funds, but there's over 36,000 equity funds in the US. So those 36,000 mutual fund managers are invested in the big companies. When those big companies drop, so will their mutual funds. So I don't want you to be afraid of that. But what I'm just trying to say is, as long as we can be prepared to know what's happening, we're okay with that. So the selling's not over. We just had what's called a dead cat bounce, and I apologize for how that sounds, but it's an industry term. It just means that even though something comes down and it drops and it hits the floor, it will bounce before it then starts to sell off or do something else. It's just an overreaction bounce is all that is. That's just an overreaction bounce. So that's what we just had on the S&P 500. Here's our little overreaction bounce right in through here. Because people say, oh, okay, now that we've figured out what's happening, then we kind of get a hold on it. We're so oversold, let's buy some of the really good companies that are still good companies. And I'm going to show you a list of some good companies that are still really good companies. And so those companies are being bought, which is causing the S&P 500 to bounce. But that being said, overall, the stock market is still going to move lower. It will not move like we just had. It will not be this big, huge drop that we just had here, but it will slowly trend lower, probably till the end of the year. And then from there, we're going to slowly pick up. There'll be some good stocks, ones that we can buy that will go higher, but the majority of the stock market will still go lower because the economy is not there yet. Think of all the money worldwide that's not being spent because people are afraid they're losing their jobs or aren't getting a paycheck. I said, well, I'm getting that government paycheck, but it's not enough to cover everything. So with that, the first part, the spending bill helps out there, but we're going to head into a recession going forward, probably towards the end of the year, till the end of the year. And then from there, it should start to slowly pick back up. So at this point, I'm estimating that towards the first part of next year, the economy will start to pick back up and we'll start seeing gains across the board in the entire stock market, is what I'm looking for. Could happen faster if some type of news or something else pushes it, but regardless of any news that's not going to push out there, anything else that's happening, the stock market's likely to be lower and so will your accounts. So just understand that, but I'm going to show you some of the things you can do. When will we know for sure when things are going to pick back up? As soon as all of the new viruses have peaked and the new cases we're getting on a daily basis, as soon as those have peaked and they start to actually drop, we'll start to see more people coming in and buying some of the better quality stocks. As soon as small businesses start to open back up, as soon as small businesses open back up and people start to get hired again, they're going to feel better. They'll start to spend some more money. At that point, people who have a job will say, okay, I'm going to start to spend a little bit of money, and some of the businesses will start to pick back up. But these are things we need in order for our stock market to turn around. So I'm just giving you a list of things to take a look at here. The highest unemployment we've ever had was back in 1933, and it was almost 25% during the Great Depression. We don't know what our current unemployment rate is going to be like during this because it won't be released until May 8th, and that'll be for all of April. So we won't know what the unemployment is going to be like. But if it's higher than 25%, understand there's going to be a lot more selling in the week right after that, because nobody knows for sure what it's really going to be. So keep an eye on that. So May 8th is when the unemployment rate for April comes out, May 8th. It'll be in the morning before the markets open up, about 8:30 in the morning, Eastern time. So if it's negative, you're going to see some really heavy selling going forward, really heavy selling. You're correct. So from your understanding, this is not the bottom is correct. So unemployment, that's May 8th. And then meantime, some of the things we can do is we can start to look for some of what's called an inverse index. And these are things that kind of work backwards. So understand that our stock market is probably going to slowly trend lower unless unemployment rate is above 25%. If it was above 25%, and everybody thinks it's going to be bad, but until you're hit in the face with it, you don't really know for sure. And I'm just going to show you here and you can just pull up these. I don't care which brokerage firm you have, they all have access to some charts. You can pull up some of these charts here. I'm going to look what here's called some inverse indexes. Now, an inverse index is just something that works backwards. So if we really are going to have the overall stock market start to go down for the rest of this year, and again, it's not going to be heavy selling, but it's going to be a slow trend to the downside because there's still going to be some good stocks. There are going to be some stocks, which I show you on the list here, that are making money that people are going to buy. It's just the majority of them are making much less money and at a much slower rate than they were supposed to make in the previous, so they're going to trend lower just because they're overvalued now. So these are called index ETFs or inverses, and we've got SDS. Now SDS is the S&P 500 inverse. For those of you who have access and you can start to manage some of your money, or if you don't manage your money, you have a different money manager, you might ask them, I'm looking for an inverse, which means backwards, ETF. And it's just a mutual fund that goes against the overall market, just works backwards. So this one actually pays a dividend, but it's backwards. So this is SDS right here, and its counterpart, if I scroll up the page here, is SPY. So when SPY, which is the S&P 500, was dropping and bottomed right here, SDS was going up and maxed out. It's just a mirror image. So if we expect the S&P 500 here to go lower for the rest of the year, SDS will actually go higher for the rest of the year. It's a mirrored image, it works backwards. And so you're still buying, you still own, and when the market drops, what you own actually goes higher. So these are things you can actually ask your money manager, am I in any index ETFs that are inverse, that work backwards? We have one here for the Dow, if you want for the Dow, this is the Dow. So when the whole Dow was dropping, the ticker symbol for the Dow Jones Industrial Average Inverse, ticker symbol DOG, was actually heading higher. NASDAQ, and the Russell 2000. So these are just called inverse ETFs. So these are things that you can ask your money manager, your 401k manager, if you have access to. So for some of you, if you're able to manage your own 401k, you might go back and see if you have some of these. There's the ticker symbols, RWM, PSQ, DOG, and SDS. And ask your money manager, do I have access to these? Because as the markets head lower, you just want to own these. Just like when the markets head higher, you want to own the S&P 500. But when the markets head lower, I don't want to own S&P 500, I want to own SDS. And then towards the end of the year, and as more good news starts to come out, I would then go back and sell my SDS, and I go back and I would buy SPY. I go back into the S&P 500 type of a thing. So by the way, if I got questions on this section I'm talking about right now as I'm going through it, just let me know, kind of type up some of those. questions, but these are things that you can go back to kind of manage what's in your portfolio right now. So the first thing we want to identify is what's happening to the economy. And the economy is still bad. You've got people saying, you had a lot of states that originally were closed for just 2 weeks and they've extended it now for a month. Will it go longer? I don't know. I'm not sure what's going to happen with it. We don't really know what's going on with it. But if I know that the economy is still going to be negative, because even when it opens up, it's going to open up very slowly. And those people who do go back to work are afraid to spend any money because they're still trying to catch up on bills or afraid they might not have a job. It's going to take a while for spending to get back to normal. So because of that, we're going to have a lot of companies that are making a lot less money than they originally were anticipated to make, which means lower sales, which means lower stock prices. So expect that to happen at least through the end of the year. What percent of your portfolio, Steve, should be in inverse ETFs? At this point, I think I would probably have about 20% of my portfolio in some type of inverse ETFs. So I'd have some inverse ETFs, and then I would then have the other, maybe another 40% in some really good quality stocks, maybe another 10% in gold, and then another 10% in just cash. And that's a good question, though. Do you suggest selling it several times as the market goes up and down? No, you just want to, this is a buy and hold type of an item. You just buy and hold SDS, just like you would buy and hold a mutual fund. Okay, so let's go back here. So selling is not done. The heavy selling is done, but now we're going to slowly trend a little bit lower as we move towards recession territory. We need to see the new cases peak, viruses. We need to see small business open back up. We need to see the unemployment stay beneath 25% on May 8th in the morning at 8:30 Eastern. And then until all that happens, I would have some money in some inverse ETFs. And the reason for this is that many investors aren't sure how do I make money to the downside? Well, you're not really making money to the downside. You're buying and holding something that goes up as the overall markets drop. So it's just a little bit easier for people. 50% inverse ETFs, 40% good quality stocks, 10% gold, 10% cash, 20, 60, 70, 80. You can go 50% index ETFs if you want, if you manage it a little bit more. I would probably go a little bit less and then more in good quality stocks. So just in case the markets do try to go higher earlier on. So you still have a diversified portfolio, but I would go maybe 20% inverse ETFs, maybe a little bit more in stocks and maybe a little bit more in gold, but I'd leave 10% in cash still. Okay, so now, first section. Second section, if you've got a portfolio right now and you've got some mutual funds, and you can take a look at your portfolio, or you can just take a look at what your money manager has, or you can ask them some questions. If you've got any stocks or mutual funds that are in these sectors, such as retail stocks, if you've got a lot of retail stocks in there, I'd probably get rid of those mutual funds, because as we all know, retail sector right now is really hurting because nobody's really going to the stores. Now, Amazon, of course, is going to be one of those that changes. I'll talk about Amazon in just a moment. But if you've got things that own Bed Bath & Beyond, Best Buy, Ulta Beauty Supply, just retail type of stocks, Abercrombie and Fitch type of stuff. If you've got any mutual funds that are retail funds and they actually have the word retail in them, I would probably want to, if those are mine, move out of those funds just because they're going to underperform the overall marketplace. And even when those stores do open back up, you have people that say, I'm afraid to go shopping at those stores still because I don't know what's happening, and I'm just going to go off of Amazon or Walmart and order online. And so if you've got any heavy retail stocks in some of those mutual funds or stocks, I'd probably, for me, I'd look at maybe moving out of those in my portfolio. I'd also move out of a lot of the financial stocks. And the reason I move out a lot of financial stocks is because interest rates are moving down to zero, and financial companies make their money off of interest, what they can charge people. And because those are dropping so much, they're not going to make that much on there. So oil prices, ETF like USO, I'll cover that in just a second here. So zero interest rates for hurting financial stocks, I'd move out of the financial sector. There's still going to be a couple good ones that will always buck the trend, but overall, if you've got a mutual fund or an ETF or something that tracks the entire financial sector, personally, I'd probably want to move out of that. And I don't want to own that just because it's not going to be the best sector at this moment in time. There will be a time for that, and I'll cover that, but for about the next 7 or 8 months, I don't think I'd want to own the financial sector right now. Oil prices are really hurting the energy stocks right now. So there are going to be some energy stocks more towards the utility industry, which are going to be good, but the overall energy sector, I'd stay away from. We all see what's happening with oil prices right now, and oil prices are dropping dramatically, and they're not likely to go up heavily anytime soon. So I would be out of the energy sector, but I might be in the utility, which is part of energy, the utility industry. So I'll cover that for you in just a moment as well. Do you trust the unemployment numbers from the BLS website, Bureau of Labor and Statistics, as much as you can. I mean, all I can do is go what's off of that, and so does every other money manager in the world. So whether the numbers are true or not, every person who reads those numbers will react to them, and I trust how they react, and that's really what I'm after. It's a good question. Do you recommend retail now or wait till the last quarter of the year? I would probably not even get in the last quarter of the year. I would probably wait till after maybe the second quarter of next year before I really went back into the retail areas. Okay, how come I can't see the other questions Mike is addressing? They're on the question section of the program. Okay, so now these are some just areas I'd stay out of. Now, if you can go back, look at your sectors, or if you're thinking about trading, or someone says, hey, I've got a good stock for you, or you're watching Kramer on CNBC and they say something, there's just going to be some sectors you just don't want to go into just yet. So stay away from those. Now, with that being said, there are actually some good areas that you're going to want to go to. So we're going to talk about some of those because these are where you want to focus most of your time on. Good question. Jason says, what about the automotive sector? You're right. I was going to actually put that on here. It's a sector you want to stay away from. How many of you have driven past any car dealership lately, and what did you see? They're full. The automobile sections, the parking lots are just loaded. Nobody's buying any cars right now. And so same thing there, I'd stay away from that. So the whole automobile industry sector, that's also part of the retail. It's kind of a subsector of retail, but I'd stay away from automotive as well. Just nobody's buying cars right now. They're just not doing. They don't have any money. They're afraid. Well, I don't want to go out and buy a new car and be stuck with over the next 4, 5, 6 year payment if I'm not sure if I'm even going to have a job anymore. So yeah, stay away from that. And there's ways that you can actually make money on that sector, so that if you need a new car, you can actually short the sector or buy puts on it and use that profit from that whole sector to pay for your car payment. Maybe if I have time, I'll get into that, but it'd be a way to buy a new car for that. Roland, you actually would understand that since you've gone through some additional training. Auto parts, I'm probably Chris, auto parts, I'm not really sure just yet. Sometimes when, for instance, like one of the stocks to buy that you kind of go down here, the first stock I have here is Home Depot. Well, the reason I have Home Depot on here, and it goes back to your auto parts question here, is simply because if you're stuck at home and you can't go to work, and you might start working from your house, and you're in your house 24/7 for a month or two, what are you probably going to start doing to your house while you're working? If I'm going to be stuck here, I'm going to start to maybe do some things, upgrade the house that I want to do. And stores like Home Depot, which kind of breaks from the retail sector, but Home Depot will actually benefit. It'd be one of those rare situations in the retail that will actually do well. Well, if you can't buy a new car, you might be forced to fix your old one. Maybe some of the auto parts will do okay. And I'll show you specifically what to look for if you're going to try to break the trend. Like if you're going to say, I'm going to go and buy a couple of retail stocks, I'm not saying that every retail stock's bad. The overall retail area is bad. If you can go into any neighborhood that's got a bunch of bad houses, and there's going to be 1 or 2 good houses in that whole neighborhood. I don't want to buy that whole neighborhood as a group, but I might focus on 1 or 2 of those houses, but I wouldn't buy the whole group. So maybe auto parts, if you can find a right one, might be okay to go back and do. It's a good question. Yeah. AutoNation furloughed 90% of their staff, says Todd. Well, okay, so let's talk about stocks to watch. And because I go back and I talk about, and I do have, Tony, some drug and health companies on here as well. Stocks to watch. Let's start off with Home Depot. Now, as I go through this kind of list and some of the areas you might want to watch, and industries to watch, and sectors to watch, and things that are probably going to do well between now and the end of the year, it doesn't mean that because they're on this list here, I'm saying go buy them right now. That's not what I'm trying to tell you. All I'm trying to say is these are reasons for these stocks to go up. Now, anytime that I buy a stock, I look for a couple different scenarios. Obviously, one, I want it to be going the direction I want. I don't want to buy a stock because it's cheap, because it's dropping in value. It's going the wrong way. It'd be no different than saying, I want to get on the freeway going north, so I'm just going to get on the freeway that's going south because eventually it will turn north. Well, that'd be crazy. Just get on the freeway that's already going north. I don't want to buy a stock because it's in a downtrend and it's cheap. It's going the wrong way. Yeah, but eventually it'll be so cheap people will buy it. Well, why don't you wait until that happens? Because it might be a year from now. So first thing I'm going to look at anytime I'm out looking for a stock to buy, I'll scan down as I go through each one of those lists on here. But as I go through this, start number 1, I want to buy a stock that's moving the direction I want. So hopefully it's in at least a new uptrend or starting to move higher right now. It's going to be the first thing I'm after. 2, I'd like it to have some good fundamentals. Just like any business, if you're an entrepreneur or someone says, hey, do you want to invest in my business? The first thing is you want to look at that business to make sure it's a good business. I don't want to buy a business because someone says, hey, it's cheap if it's losing a bunch of money. So I want it to be moving the direction I want. I want it to have some good fundamentals, which means it's making money. And then 3, what I'd like to have is that there can be some reason to buy it. And that's what we're looking at right now. These are stocks to watch. These are stocks that have a reason. So some reason that will make people want to buy the stock. And that's really what I'm after here. So number 1 is Home Depot. So you can just kind of write these down as I go through, and I'll scroll down the list as I get through each one of them. But anytime I'm taking a look at Home Depot, and let's just pull up a chart of it here, HD. You can pull up a chart on any of your, whatever your brokerage firm is, whatever websites you use, you can use that. I'm on my website, which is incompetitor.com. There is a 2-week special for just 99 cents. I'll show where that's at. After that's just $25 a month. But looking at a chart, you can find anywhere. You can get a chart anywhere. So all I'm doing right now is just looking at a chart. So if you already have a brokerage firm, I'm sure they have charts for you to go back and look at. So here's Home Depot. We can see, and I start off by a 6-month chart. I can just change the time frame, by clicking down here at the bottom, what I want. But I'm just start off with a 6-month chart. And it was going sideways for a while. Coronavirus kicked in, and now it's starting to move higher here. It is part of the S&P 500, the 500 largest companies in North America. And yes, a recording will be available to you. I'm not sure if it'll email, but it'll be available on the Protect Wealth website, Laura. So Home Depot has a reason to go up, because if people are going to be staying home, they're going to have a reason they want to fix up their house, and they're going to be going to Home Depot, they're going to be buying more. So there's a reason for it to go up. And I think you're going to see, if you just kind of walk through neighborhood now, how many of you actually seen people actually working on the house right now and doing things to it to make it better. So if they're not going to work and they're working from home, they're probably going to see more business for Home Depot as we move forward. So it's a reason for it to want to go up. Home Depot right in through here. Next one on our list as we go through here, Clorox. Anybody know we want to take a look at Clorox, CLX? If I go down and look at Clorox and pull up our chart, fundamentally not a really strong stock, but there's a reason for it. And if we take a look at our chart here, wait for it to kind of pop up on our stock, people are going to use this to disinfect things. And moving forward, how will our economy change? I'm kind of actually looking forward to how disinfecting terms, how the economy is going to change. What do we do? Every time you walk into something, how will it be different a year from now than it was a year ago? How will things change? Because as much as we freaked out, remember, the whole world economy dropped because of a coronavirus in 3 weeks. The whole world, not just a state or a city or a town, the whole world. So that just shows how much fear and panic is out there. Real, not real, I don't care. Whatever it is, it's there. So it's a perceived item. So how will we change? How's our economy change? So how will disinfectants, and Clorox is the big one out there, how will it change and merge and be a part of new everyday life, and how much more business will it get? There's a reason for it. And just look at this whole thing right through here. Here's the coronavirus spike right here. There's your coronavirus spike right there, and then it kind of pulled back, and now we're just back into a normal uptrend. So maybe this is a stock that you might want to just own a long period of time. And the more that it has more business, the better the fundamentals will get, because more people buy it, the stronger it gets fundamentally, where it becomes actually a pretty good quality stock. So Clorox is one to take a look at. So I'm just giving you ideas that you can go back and do some more research on, but these are stocks that have a reason to want to go up going forward. So the first thing we do is we have to understand that the market will probably still trend lower between now and the end of the year, and that will have a major impact on your portfolio, whether you think it will or not. Your money manager, whoever they will not do what I'm telling you to do right now, because they're too big. They can't. They just have too much money to spend, and they can't do the whole portfolio. That's why you have to take advantage of some of this. And at the very end of this, I'm going to show you some specific things you can do today to make money today. So Clorox, next one, AMD. These are some of the stocks that I like for different reasons. Advanced Micro Devices, AMD. If everything that we start doing now going forward is going to be online, and there's going to be a lot more online going forward. We knew we were going there anyways, kind of like self-driving cars and electric cars. We know we're going there at some point of time, but until sometimes we're forced to actually do it, we just don't do it. And so we know there's going to be a lot more things going online now, especially with 5G coming out and the internet and everything getting much faster for us. So everything that you do that's going to be online, internet, technology has to be powered by a chip. So what's one of the better chip makers out there? Intel's a good one, Taiwan Semiconductors, TSM. I like AMD, Advanced Micro Devices. Still fairly expensive. Didn't have a really big sell-off in the coronavirus, kind of went sideways for a while, and is now just starting to kind of slowly trend a little bit higher. It's only about $47 a share. So AMD is a nice one that I like. Remember, every single thing going forward that's going to be online, all of your work habits, all of your telephones, all of your videos, everything's going to be online. You're going to need faster and faster processing chips, and AMD is one of the leaders in there, in that sector. So it has a reason to want to go up, because the more we move to online, the more we need technology, the more we need faster processors. And so it's going to always be at the forefront in that area, AMD. Obviously, Netflix is an easy one. I'm sure you guys understand why I'm taking a look over here at Netflix. How many of you have been sitting at home, and how many shows have you guys been binge watching? Because I know I have. You start watching a season, it's a season one, and before the end of the day, you've watched the entire season. And so they're just getting new customers. Now, this stock is completely overvalued. It's very expensive. It's way overvalued, but people are still buying it because it's still expected to grow. Nationwide is having a huge influx of brand new customers right now, huge influx of brand new customers. So Netflix is one to take a look at, NFLX. A couple more here. As we're staying home, I'm a little bit older, I'm 57, but there's still a lot of people that from different generations that are on their Xbox and video games, like my son. And so stocks like Activision and EA, ATVI and EA are video game stocks. And those are good quality companies. So if we take a look at here, let's look at EA, Electronic Arts. And we'll wait for that to pull up, and we'll take a look at it. My internet working a little bit slow here. So here's a chart of Electronic Arts. So you saw after the coronavirus sold off, and then where did the stock go right after that? It started to pop right back up again. It's kind of moving higher. So technically, the stock, if I'm just taking a look at it, pulled back, had a nice little, went sideways for about 2 weeks, and now slowly just been moving higher the entire time, because people are trying to say, after we all panicked and what's happened, we all panicked, then we start thinking, okay, well, the panic's done. Now, how can I start making some money? What are some of the stocks people are going to look at? People say video games. People are playing a lot more video games, so stocks are going up. Some of the technical indicators, those of you who like to read charts, I've got what's called a Coval indicator here, which is an oscillator, and MACD, a Nobel Prize oscillator, both of them saying buy situations. But here's what I'm looking at, as I'm looking at some of the fundamentals for different stocks. Let me scroll down, and this is on our website. But when I'm talking about fundamentals, and you can see some of these fundamentals on Yahoo Finance, you won't get the whole list like I've got here, but here's what I'm after. If I'm gonna buy a stock that I expect to do well long-term, what I'm really looking for, and this would be the same thing for any business you might wanna go into, even as an entrepreneur, so it'll make some sense as I go through that. The first thing I really want to make sure is the stock actually making money? And what's called down here, the net profit margin, which really just means profit for the trailing 12 months TTM. 52 cents of every dollar this company brings in sales, it makes a profit. So this company brings in $1 of sales, 52 cents is profit. Now you go to the 500 largest companies in North America, which is the S&P 500, the 500 biggest companies, which would be your IBM and your Boeing and your Netflix and your Google, the 500 biggest companies, they only make about 12 cents on the dollar, about 12 cents a dollar for the biggest 500 companies in North America, where Electronic Arts, it's all video games and all their items you can just download them. They don't even have to create a real product that they hand out type of thing. It's all online. 52 cents, which is huge, 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 huge. All the other stocks in their same industry would be like all the other houses in your neighborhood, only make about $3 or only make about 3.8 cents per share. But this company makes 52 cents per share, which means they're making just a ton of profit, which is cool to have, a ton of profit. They're also, if we just go back and take a look at this, their growth, and this is a big one. If I'm gonna buy one of these stocks that I expect to do well going forward for the next 1 or 2 years until our economy gets back on track and I can just go back to normal investing, I gotta think, what's the growth? Because if I wanna buy the stock, but I also wanna buy the stocks that the mutual funds wanna buy as part of what they're after too. So the growth rates, this is my sales for quarter over quarter. In other words, the last 3 months versus the same 3 months a year ago. This company grew 23%. Down year over year, but over the last 5 years, 4%. But here's where it gets better. So sales are actually growing, but profits are growing huge, which means that even though sales are growing, profits are growing even faster. So they're finding ways to become a better, efficient company. And so quarter over quarter, profits are up 34%. Year over year, 14%. And the next 5 years, this company is expected to grow their profits by 16% every year for the next 5 years. That's huge. That's really nice. couple other things on here that you'll see as you go down here. Verlin, some of you guys recognize this. Current ratio, how much cash in the bank. This company has enough cash in the bank to run for almost 3 years before they run out of cash. That's how much cash they have. And they have very, very little debt, just like you'd want it to if you were going to buy a house, want no debt. So this company is growing sales and profits, lots of cash in the bank, and makes a huge bottom line profit. When a company makes this much money, they're generally going to be some type of an acquisition target because somebody else wants their cash, which means that somebody's going to want to buy this company out. When they buy a company out, they always offer a premium. So if I'm thinking about buying a company, I just want to make sure that they're growing sales and profits. And there's somebody that's called fundamentals. What's the internals of the company? And that there's a reason for somebody to buy the stock. Well, the reason for this is because people are going to be home watching more or playing more video games. As they play more video games, they're going to be spending money, which means this company makes more money. On top of that, we know sports is huge. So take a look at this. How will the NBA, the NFL, NHL, hockey, and baseball, how will they start to somehow merge with these video games? I know that they have Madden, football, things like that, but how will they somehow combine together in a new economy? I don't know. If we're not going to be having huge $60,000 arena events for football games anymore, how much of it will be maybe on some type of an Xbox? I don't know. I mean, I really don't, but there's some type of a possibility for that because we're moving that direction where more and more things are going to be online. So how can we maybe sit home and play a video game and help participate in an actual football game? Wouldn't that be interesting? So it's out there, but I'm just saying, is there a reason for these stocks to go higher? What about online gambling like Scientific Games Corporation, things like that? Susan, is that something that you're quite familiar with? I'm just making fun. I'm just, you got to be a little bit levity here. The answer is both yes and no for that, Susan. So the question was, what about online gambling like Scientific Games Corp, SGMS, and more gambling from remote locations? There's a weird dichotomy when it comes to that, and the answer is both yes and no. When people panic and are fearful, companies like Scientific Games, gambling, will go higher, but so will alcohol and tobacco and guns and ammunition. It's called the defensive sector. And so when people are scared and nervous, they go for different areas, and gambling is part of one of those areas. So if we really are fearful of the economy going forward, yes, those companies will go even higher. For people will go out and they will do more online gambling versus going to Vegas because they can't go to Vegas anymore. So yes, that is an option. So SGMS is the one you're taking a look at. I haven't looked at that one lately, but yes. So now EA. So video games. So these are some of the video games that I take a look right through here, right into here. Gold, we all know this one here, and probably about 10% of your portfolio should be in just GLD. And the ticker symbol, instead of actually going out and physically buying gold and have to hide it someplace so that nobody will see it and steal it from you, you can actually buy the ticker symbol GLD. And GLD is kind of like a mutual fund, but it's called an ETN, exchange traded note. It's just, think of it as a stock that tracks the price of gold at 1/10 the price, 1/10. So if gold's trading at $1,560 a share, you're going to see this trade at $156 a share. Trades about 1/10 the price. But now you can actually trade gold with just buying the ticker symbol GLD, and about 10% of your portfolio should be in this, because as the markets get nervous, gold will generally start to move higher. It was really weird when it dropped with the coronavirus. That's very, very unusual. But as people get nervous, gold should continue to move higher. It's called a defensive stock, and people always want gold. The good thing about gold, you can look at silver. SLV is much cheaper than GLD. So the question from Frank said, would you look at SLV, which is silver, versus GLD for gold? Yeah, they both do the same thing. Silver is just much less expensive. But typically more people go for gold, but silver would still work. The nice thing about both of those, SLV and GLD, it's a note, which really means that if you buy this ticker symbol GLD for whatever price you pay for, $156 a share, you get a couple bonuses versus just going out and buying gold and hiding it and burying it someplace, getting Alzheimer's, forget what you got. The company that holds your money also has to actually hold gold. They hold it and store it for you. So you actually own the gold, but they're storing it for you for free. And if you ever want the gold, you can just say, I want to unwrap my ticker symbol GLD, and you give them the ticker symbol back and they will actually ship you the gold. So they're holding it for you, which is a really cool item, and you don't have to store it, and you get it at 1/10 the price. You can also write a cover call on, which I'll talk a couple seconds here at the very end of this whole process here. So good one to go back and do. Sell enough gold to cover your margin calls if you want as well. There's another way to look at that, yep. So now, GLD is one to take a look at, and generally right now about 10% of your portfolio should be here in GLD. And yes, you can look at SLV at the same time. Costco, big retail stock. Costco, it's overpriced, it's expensive. So Costco, so we're looking at GLD right now. Ticker symbol here for gold. Let's go back and look at Costco, COST. Now this one here is a little bit expensive and it's overvalued, which means that you're paying too much for it. It's like buying a house, excuse me, for $400,000, but every house in the neighborhood's only $300,000. Excuse me. By the way, anybody else here have sinus problems? Usually in the morning I wake up, I got to cough a couple of times. I'm afraid to walk outside and cough because I'm afraid all my neighbors are going to look at me and call the police and say he's sick, haul him away. Anybody else have that? Yeah, allergies. But usually, you know, they're gone in like an hour as soon as you wake up. You just got to kind of wake up. So now, Costco, it's like buying a house for $300,000, but every house in the neighborhood's only worth $200,000. So you're overpaying for it. But it is one of the big 800-pound gorillas in its place. It's not going to go away. So it is overvalued. It's always going to be here. So if you're looking to buy a good quality stock that's still going to be here a year or 2 or 3 years from now, even when the next virus comes out a year from now, Costco will still be here in place. So if you want to have one of those stocks that's just going to be kind of sideways, it's not going to really go too much. And the reason it won't go too high because it's already, you're paying too much already. So it doesn't have a lot of growth to it. It's just a big steady stock that's not going to go away. So if you want a stock like Costco, it might be one to add to your portfolio, and just understand that when the market drops 30%, your Costco might only be down 5%. So it's just one of those to kind of hold and maintain your stock, but also it's a big company. It's not going out. I mean, how many people are still going to Costco and shopping? You know, it's still there. So that might be one just kind of hold on to. Don't expect huge amounts of gains from it, but do expect it to maintain itself and to slowly increase between now and the end of the year. So expect it to slowly increase. So that would be Costco. Here's some a whole list of stocks right in through here. This is kind of like the whole industry. So I'm just going to go through all of these, and I'll show you one and what I did with it as well. So in reference to gold, what do you think about the Fed printing so much money? I think it's really scary they're printing so much money. It's really scary what the Fed's doing right now. For those of you who don't really know how the Fed works, so the question here was from Will. We are the only country in the entire world that can print money whenever we need it. No other country is able to do that. We have a series of checks and balances that aren't really checks and balances. If we need more money because we're in debt, we're overspending, we just have the Fed, and here's what happens. The Fed actually goes to the US Treasury Department and says, US Treasury Department, we the Fed need money. And the Treasury Department has to print up money and give it to the Fed. Now the Fed has that money, it loans it back to the US government to pay the bills. It's really scary. No other country in the world can do that. And so right now, you know, we're trillions of dollars in debt that the actual Fed owns, US bonds, notes. It's really scary. Yeah, The Creature from Jekyll Isle is a good book to go back and read. But eventually that's gonna implode. It can't happen forever, you know, so it's just kind of a weird situation. But here's a good area right here. And I like this area going forward. It's going to be one of the hot areas. So if you're looking to kind of like where will probably be a better sector, well, I was just kind of covering some overall individual stocks at random. This is a whole sector that's going to do well. It's like buying a whole neighborhood. Every house is going to appreciate in that neighborhood. And this is kind of the online video services, business to business services sector that helps everything online. And so you got companies like Ciena, S-C-I-E-N, Citrix Systems. By the way, Citrix Systems owns GoToWebinar, which is what you're on right now. GoToWebinar, that's Citrix Systems here. But let's just take a look at the first one here, Ciena, C-I-E-N. So I'm just going to type in C-I-E-N, and I'll show you how I acquired the stock and what I'm personally doing with this. And by the way, it's not a recommendation. I'm showing you as a professional investor, there's things that I look at to make my money. Just because the markets are dropping doesn't mean I want to lose money. There's still things we can do in any market scenario. So we're pulling up right now Ciena Corporation. And you can see that right now it's trading around $45 a share. That's where it's trading at. I'm going to click on find out, okay, well, what is it that they do? Why would I even be interested in this? And so I'm going to click on where it says company. And it says, if I just kind of go through here, Ciena Corp is a network strategy and technology company. It provides network hardware, software, and services that support the transport, switching, aggregation, service delivery, and management of video data and voice traffic communications networks. Does anybody think that that's going to be a bad sector in the future? Is our online services, is our online internet, is our 5G, is anything going to be going backwards or going to be going forward? This is the sector that everything's kind of moving towards in our online digital agency. So this is kind of one of those companies that provides the services and the backbone and the software and the data for all of those different kind of companies. So it's a company I like. It's also, if I go down and take a look at this right here at Sienna, it's a good quality stock fundamentally. And if I look at my growth, and again, you can look at growth on Yahoo Finance, MSN Money, whatever you look at. It might not be this pretty as I have it here, but you can say, what is my quarter over quarter growth for any stock? Quarter over quarter growth, as I take a look at this, it's grown about 7% this quarter versus the exact same quarter a year ago. Year over year, 15%. The 500 biggest companies in North America are only growing year over year 4%, but this one's at 15%. 5-year growth rate, it's been growing about 9.6% a year every year for 5 straight years. That's pretty cool. But here's what's even more important. Look at how the profit's growing. So sales are up, but profits even more, which means the company's doing even a better job managing the money from the sales it brings in. That's fantastic. So 3 months versus the same 3 months a year ago, up 67%, 64% year over year. And it's been growing its profits by 26% a year every year. So think about this. After you pay all of your bills every month, what if for the last 5 straight years, that amount of money is growing 26% a year every year for 5 straight years? That's fantastic. We like that type of stuff. As I go down even lower, lots of cash in the bank. This company has enough cash in the bank. It's called current ratio. And in its simplest forms, current ratio just means how much cash do you have on hand to pay your bills if you had no more sales coming in? And this is on a yearly basis. So if this company lost all sales, they could still pay all of their bills at their current rate for 3 years before they're bankrupt. It's like you having a checking account, you got laid off from work temporarily, but you got enough money in your checking account to go for 3 straight years before you get hired again. And you have very, very little debt, very little debt. Think about 7 cents, 8 cents on the dollar. So company I like, it's one that I'm into right in through here. So this is a company that I like. So if I want this kind of a company, I gotta go back and take a look at the chart. Say, okay, well, the chart looks good because over the last 6 months, which way is it going? I jumped into it back here around $38 from our students that they have on the website here. But I'm showing you the same scenario here that can still be used today, a little bit different price, but still used. It looks good. So if I'm looking at this chart right now, here's where it was over here 6 months ago. And over the last 6 months, it's gone, whoops, where do I want to go? From here to here, last 6 months. It's been an uptrend. Even though the whole market's dropped, it's an uptrend because this is the area where everything's going in the future. So people are starting to buy the stock. I like the stock. So fundamentally, it is a good company fundamentally. I like the trend and there's a reason for me to buy it. So if I'm interested in buying a stock like this, there's some things I can do to actually increase my rates of return. So let me just go through some of those. Now this is gonna be a little bit fast for some of you and you can go back, you can watch this video again, but I just wanna kind of show you that with a little bit of knowledge, how can you make even more money versus just letting your mutual fund managers and your 401k managers, IRA managers take all kinds of fees from you while you're still losing money. And so I want to buy the stock, but many of us don't know that there's many different types to buy the stock. And so if I want to buy the stock, I can go to my brokerage account. And right now I'm on, let's see if I can bring this up for us. Oops. Where did we go? Here we go. My brokerage account over here. My brokerage account. I don't care who your brokerage account is. It works the same way no matter who it is. I'm working right now with TD Ameritrade. This is my personal account. Right here is my personal account. If I want to own the stock, I'm just going to type it in. And if this is moving fast for you, don't worry about this. All I'm just trying to show you is there's options for you. These are easy to learn. Doesn't take very much, but here's some of the things you can do to actually buy the stock at a discount and have someone pay you money to buy it and then make money through monthly rentals and dividends. So ticker symbol CIEN. So type in the ticker symbol CN and it'll pop up right here for me. There's my ticker symbol. It's trading around $45.50 a share. I like the stock. I would like to own the stock. I want to put it in my portfolio. What's really cool today, guys, is that there's no commissions to buy stocks. All the brokerage terms have now changed, unless you've got like a JP Morgan or Merrill Lynch. But if you're using TD Ameritrade, Schwab, Fidelity, E-Trade, you're using any of the big major retail firms, they're free. It doesn't cost you a penny. So you can just buy one share if you want for $45.54. If it goes up $1, you made $1 because you can sell it now for 0 commissions. You made $1. It's really cool because you can just do one share if that's all you want, or 10, 15, 100, 200, whatever you're after. But if I'd like to buy the share, buy the stock, I'm going to go down and I would like to have someone pay me. So I'm going to go down right here where it says May 15th, 2020, 15th of May, 2020. And this is about 38 days away. If I click on this, and I'll actually tell you word for word how the trade is. So if you're interested in this, you want to talk to your broker, you just say word for word what I say right through here. Again, I'm not recommending this. I'm not your licensed broker. We have a license. My company actually manages money at the same time. We're a large money management company, but these are things that you personally can do without having to pay somebody to manage all your money and make money for you and take all their fees. There's things that you can do. So the stock right now is at $45. Everybody understand that? It's at $45 a share. I would like to buy this stock for right around $40 a share. I like to buy the stock for right around $40 a share. I like it. It's a good looking stock. Now I can choose different prices. So if I just kind of go back to the chart here, I can say I'd like to buy it for 42, 40, 38, different prices. I would like to buy it where it was 1, 2, 3, 4, 5 days ago. I'd like to buy the stock for $40 a share where it was 5 days ago. So I'm gonna go back to the chart. There's $40 right there. Right now, someone's willing to pay you 65 cents per share, 65 cents a share, so they can sell you the stock at $40. I know that sounds weird, it really does, but somebody's willing to pay you 65 cents per share so they can sell you the stock at $40 a share right there between now and May 15th. And all you have to do to do that is right click, sell. Don't worry if you don't understand, so I'm gonna explain to you in just a second. Single, and it comes right down here, close my trade. I would like to do, and let's just do 100. I would like to buy 100 shares of CIEN at $40 a share anytime between tomorrow morning and May 15th. And I would like someone to pay me, what was that price we said? It was 65 cents a share. So I'm just going to type in 65 cents a share. That's it. And now you actually say this, and if you don't get it right now, go back and rewatch this. I would like to sell one contract. I would like to sell one contract of CIEN May 15th 40 put for 65 cents. Now, if I went too fast, again, go back and watch this. You can go back after this video is done. You can go back to the Protect Wealth website with Don and Kendall, and you can watch this. And this will be about 55 minutes into the presentation, about 55 minutes into it. And you just say right here, I would like to sell one Sienna May 15th 40 put, 65 cents. Somebody will actually pay you 65 cents per share, bam, just like that. And they have to. They got to pay you the money, 65 cents. That's our price right here. It's our mark. And now someone's going to pay you 65 cents per share so that they can sell you this stock. I'm just taking the current prices at $40 a share. Why do they have to do that? I don't know. They're the one that posted the price, but because they posted the price, they've got to give you the money. So someone's going to pay you money to buy the stock at $40 a share. Now, here's the kicker. They might say between now and May 15th, I don't want to give you the stock. And they're not going to sell you the stock, but you still get to keep their 65 cents a share. Now, if the stock does pull back, you'll buy the stock at 40. If it doesn't pull back, you won't get the stock. But the whole reason you do it is because you want the stock. So versus buying it right now for $45.50 a share and buying it tomorrow morning at $45.50, I don't want to buy it for $45.50. Because what if you bought it tomorrow at 45 and then Tuesday, Wednesday, Thursday, it dropped to 43, never went any lower, but then went back up again? You're not going to buy it. But if it drops, ever pulls back to $40, someone's going to sell you the stock. They'll turn around and bounce again because it's good quality stock, but you'll end up buying the stock at 40. You got paid 65 cents, and now you actually ended up owning the stock for $39.35 a share versus today's price of $45.54. And now that you own that stock, it pays a dividend. Some will actually pay you cash every quarter just because you own it. And now you've got a good long-term stock that's going to do really well in our new economy with all of our online everything going forward. You match it up with a stock like AMD, and you're in a really good sector. I like that. Pretty cool. So yeah, the mark price is just the difference between the bid and the ask. That's what the mark is. The mark is take the bid, the ask, right in the middle, that's the mark. Whenever the markets are closed and you have a volatile market, you never really truly know what the price is. That's why you always go with just the mark price. And so the mark is just the difference between the bid and the ask, right in the very middle. So now you get paid 65 cents per share to buy a stock at a cheaper price. You're either going to get the stock or you won't. Either way, you're going to get the 65 cents per share on 100 shares. It's kind of a cool product. So that's what I did to own the stock. I like the stock. I wanted to own it. I'm not recommending it to you, but this is what I do for a living, and I like the stock. So I said, if I want to own the stock, I had someone pay me money to buy it. Yeah. Is there a minimum amount of shares you can do? Yeah, you have to do 100 shares at a time. It's a good question, Gregory. So if you're going to do this, you actually have to do 100 shares at a time. All right. And now once you have that stock and somebody gives it to you and you own it, take a look at this. Because you own that stock. And let's say that you had to wait till May 15th to own it. But now that you own the stock, it's yours. And stock is, let's say the stock goes back up and it's trading around $43, $44, $45 a share again, because it's starting to bounce again. If you own the stock, somebody will actually pay you money to buy it at a higher price. As an example, right now the stock is $45.50 a share. If you own the stock today, somebody's actually willing to pay you money to buy it from you at a higher price. Right now they're going to pay you about $1.50 per share, which is the mark, $1.50 if you own it today, to buy it at 46. It's kind of like a covered call trade for a house. In other words, if you own the stock, somebody will pay you monthly money every single month to buy the stock from you every month at a higher price, whether it goes up or not. So they'll give you what's in this column here to buy it at that price. They'll give you what's in the column over here to buy at different prices. They'll pay you cash to buy it from you at a higher price. So whatever stock you own, if you say, you know what, I know the market's going to drop, but I still want to buy a couple really good quality stocks, and every month somebody will pay you cash to buy the stock from a higher price. Now, I know you guys don't, many of you don't understand how options work, you don't know how covered calls work, but these are things you want to go back and learn. It takes all of an hour to learn what a covered call is. A covered call is simply, if I own a house, someone will pay me money to use that house for a month to rent it out. If I own a stock, somebody will pay me money to use my stock for a month. It's still your stock, but they'll pay you money to use it for a month. If it goes up, they'll actually buy it from you at a higher price. If it doesn't, they're still going to pay you money every month, whether it goes up or not. And you can do this on about 3,000 different stocks in North America. Pretty much every stock you can think about, you can do it on. All the S&P 500 stocks. So if you own a stock, someone will pay you money to buy it at a higher price. So I want to own good quality stocks. And when I own those good quality stocks, I want someone to pay me money to buy those good quality stocks. And when they pay me money to buy those good quality stocks, I want them at a discounted price. I want them to pay me money to use my stock every month. It's still my stock. If I own a house, I'm going to rent it out every month, so I get paid. Whether the house goes up and down, someone's going to pay me money to use my house every month. If I own a good quality stock, I want someone to pay me money every month to use my good quality stock. It's just extra money. So if my stock only goes up 5% next year, but I can have someone pay me 1% a month to rent out my stock, and I get another 12%, I made an extra 17% this year on a stock when the stock market goes down. That's pretty good numbers. And it's not difficult. The first thing is, find a stock that fits the three criteria. It's moving the direction you want, has a reason to go up, and fundamentally, it's a good quality stock. So some of the other ones in that same category, Citrix Systems, CTXS, and the other ones that do a lot of the webinars like GoToMeeting that we're on, GoToWebinar we're on right now. Zoom, ticker symbol ZM. What's happening with that? It's still a good quality stock. This stock is going to be a hot stock in the future. It's going to just, for the next 5 years, it's going to take off. It had some problems with some security issues with it because it grew too fast, and people say, oh, we found a security issue with it, but that's fixed. And so that goes away. And just like any company, you're going to find issues here and there, and you're going to have to patch them. Microsoft has security patches. Google has security patches. Apple has security patches. Zoom had their first security patch. But Zoom, ticker symbol ZM, is going to be a really good one to buy and hold going forward. In that same category, YY is in that same category. VEEV, this is a really nice one here, VEEV. They do a lot of data services providers type of stuff for 5G networks and for a lot of medical companies. So that's going to be a really nice one too, the same type of network as VEEV. Zoom, ZM. I want to see a chart. That was a question, so I'll pull it up. Wait for the chart to pop up for me. Again, I just got a slow internet with everything kind of going on through here. All right, so here's Zoom. Nice uptrend, 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 uptrend. Coronavirus broke out. Here's a coronavirus breakout right here. And then Zoom took off. Now it's just kind of getting a pullback because it got way ahead of itself. But now you're able to buy Zoom at the same price it was before the corona outbreak, right here around $100. You can jump in around $100. That's a great stock. I like the stock. I think it's going to be going forward. If you just bought and held the stock, It's going to be a great one to buy and hold. You're not going to buy it this week and sell it next week. This is a buy and hold stock that's going to do well this year, next year, next year, next year. Great technology. They're in the forefront of a lot of things out there. It's just going to continue to get better for them with what's going on in the overall marketplace. So that's Zoom. So Sienna, Citrix, ZM, YY, VEV, Work. Work is another kind of a company that does a lot of online connecting people who work together online. And so it's kind of a virtual environment for everybody to kind of work together. Yeah, Zoom is also a potential acquisition is correct, Lynn. And so that's a good question. So I want to kind of talk about that for a second as well. Thank you for bringing it up, Lynn. There's going to be a lot of little companies that are going to have a hard time. They've got good technology, great everything, but because of the economy, they're going to do really poorly. Well, then you've got big companies that are out there that still have lots of cash in the bank, companies like Apple, that need to still expand and grow. Because Apple can't continue to be a good quality stock just off of iPhone sales. Because what's happening is, if you got an iPhone, you got it. You're going to buy a new iPhone every time it comes out? No. And then you've got all the competitors out there. So Apple's a good company, but they have to continue to grow for investors to still buy the stock. Because investors don't buy the stock, whether they make a good phone or not, the stock goes down. So how will they continue to make a profit? The same way the beverage companies make a profit. Where else are you going to sell Coca-Cola and Pepsi? It's already in every single restaurant and store you go into. So how do they grow? Well, they said, you know what? Let's sell people bottled water for more than the bottle of Coke. And we bought into it. And now they sell bottled water for more than a bottle of Coke. And that's where they make their profits. So they just keep buying more bottled water type of companies. Well, companies like Apple and other companies that still make a lot of money, have cash in the bank, will look at companies like Zoom and say, great technology, it's things that we can use as well. And as it grows, it'll bring us more profit. So it's an acquisition type of a company. So if you bought and held the company, it'll probably be bought out sometime in the future. So you're correct, Lynn, with that question. So you're going to see a lot of companies that are acquisition companies going forward. So this is a whole sector right here. These are stocks that I like. I like all of these stocks in the sector right through here. And I'm almost done here, so I'm a little bit long, so I'm going to finish it up really quick here, guys. Last sector I like here is anything has to do with cloud, with online videos and cloud computing, because that's where we're kind of going with everything's going to be online cloud computing. So I like Google for its YouTube. I like Microsoft for its cloud computing. I like Amazon for its cloud computing. I like Cisco, VMware, VMW, and DLR. All of these are like cloud computing and data centers type of stuff. And so it's a whole sector that's going to do very well. I like all of those in the sector. So these two sectors right here are going to be really the two hot sectors in the entire marketplace for at least the next couple of years. And then just other big companies. Apple, obviously. Visa, not so much right now, but Visa will eventually be a company people start jumping into because they're going to have to start using their credit card because they can get behind on their jobs. So Visa is eventually going to do okay. And companies that pay a high dividend like PSXP, Paul Sam X-Ray Paul. These companies pay a high dividend over 10% a year. So if you just bought and held the stock, they'll pay you more than 10% a year every year just because you own them in the form of a dividend. And so you're going to see a lot of big institutions go for some high dividend stocks to offset the declining marketplace. Country ETFs, I'll get that. And by the way, if you just want to make sure you have a job going forward next year, go to work for the government. It's just going to get bigger over the next year. So if you're afraid that you're going to lose your job, you want to make sure you still have a job, government's going to expand on us over the next couple of years. I just see it coming. So that's kind of an area that you would say that if I want to make sure I don't get laid off in the next couple of years because of whatever's happening, that's a sector that's still going to go back and do well, guys. I know I'm a little bit long. I apologize on that. A couple of things that we talked about right through here. If you're interested in just a 2-week trial of the website, just go back to our page here on incometrader.com and just kind of scroll down the page and click on sign up. And it's just a 2-week trial, 99 cents. You can cancel anytime you want, all online. Don't have to talk to a single person. After that, it's just $25 a month. Now, what I do have, which I'm kind of excited about, Don asked me, said, Mike, we need to, can you do any live streaming because that's kind of coming up? And we're just kind of getting into it right now. So as we get into the live streaming, I've got 4 live streaming classes. They'll be about 45 minutes long, each one of them, on a weekly basis for 4 of them for $99 total, so $25 a week for 4 live streaming classes where you actually see me on a live stream event. They'll be at nighttime, 8:30 at night, just like right now. And they'll start in a month, and I'll go through 4 weeks, and I'll go in a little more in detail how to make money in today's environment. I'm not going to go back and talk so much as what's happening through here, like I talked about first thing this morning, or some bad sectors. I'm going to talk more about how do I just actually make money in the current environment. This is going to be more about a money making, and I'll place a couple live trades in the actual live streaming event. So if you're interested in that, there's a ticker. Somebody goes, go to incometrader.com/1.php. It's $99. And there'll be 4 live events, live streaming, as I kind of test our live streaming system to kind of see how it works. I'll record them, send them to you after the event, but you can ask questions that you'll see me walk around. I'll be talking kind of the whole thing through here. We'll be live, and it'll be about 45 minutes to maybe an hour long for each one of them, but no more than an hour long for each one. And so if you want that, it's $99, and that's the web address, incometrader.com/1.php. Other than that, guys, I know I talk fast. And so question on through here, Mary just said, if you want to go back and re-watch this video, you can do so at protectwealth.com, and Kendall has that email, so just go back to the website and you can watch this video again, and it's saved for 30 days. So after 30 days, it's gone, so you can go back and watch it again. So if you want to hear anything I talked about, you want you want to know what to tell your broker, what to tell your financial planner, what to tell your financial advisor, so what's in your 401k, your IRA, go back and watch us again and see what sectors you should be into, some things you might want to consider moving out to, and maybe where to put some of your money, park it long term. But I will explain it again. The market will be lower between now and the end of the year. So if you have any type of mutual funds, you've got about a 95% chance it will be lower at the end of the year. So not huge sell-offs like we just got done with, but just a slow kind of a melt down to the downside. So kind of that's where we're at. So guys, hopefully I didn't go too fast. If you got any more questions, I'm sure you can just email me, mike@incometrader.com. I'd be happy to answer them. And with that, Kendall, Don, if you guys are ready to kind of move back into it, thank you for your time here, guys. And hopefully this was helpful for you. But be prepared, guys, because your brokerage firms will not take care of your accounts like you can take care of yourself. And so you need to start to take some movement in your own accounts and make sure that works for you.
All right, so Kendall, pop on here. Kendall always records the video and then makes it available. It generally takes about 24 hours. But Kendall, when do you think you'll be able to post this?
Yeah, probably tomorrow. We have it's being recorded now, and usually it's ready pretty quick. Just depends on you know the GoToWebinar platform. So we'll send it out as long as you're registered for the webinar. We'll have it ready for you tomorrow afternoon, probably.
And watch for their emails, because you're going to send it out to anyone who was registered for the webinar, whether they attended or not, right?
That's correct.
And then if they want to share that with somebody, how do they do that?
Ooh, that's a good question. You know, you can share the link with them, and it should be available to them. Again, it's only for 30 days. And again, that's not every webinar we do, but of course, we love this. We want our students to have this information from Mike. So 30 days available, and you can actually forward the email with the link in it. And if you have any problems, give us a call.
Okay, Kendall, will you type in that $99 offer? We've had quite a few people ask how they get this type of training, and if Mike does any other training besides iron condors. Are you kidding me? Yes. And this $99 offer, I've never seen him do a $99 offer. So
not for 4 live sessions, yeah.
Yeah, Mike, I'm not sure if we got all the questions. I think we answered as many as we could. Are you gonna offer us the same course that you offered at the events? No. Washington will be very different.
Yeah. No, I'm not. I don't have. What I'm going to do is just 4 1-hour or 45-minute sessions. I'm not going to cover anything that I've done at the regular Protect Wealth event. So this is not this at all. This is just how can I take advantage of the current marketplace and make money. There will not be any condors on what I'm going to teach going forward. Just what can I do? I want to make some money, but no, it'll be a little bit different type of strategies. But I want to take advantage of it. I mean, there's trades for us right now. If I'm in the marketplace, it has up days, it has down days. How can I make money right now to offset any losses that are currently in my account? That's all I'm after. And I don't care if the market goes up or down. We're going to have some wild swings, but there's still some very simple things we can do. And I'm going to keep it really simple, so I'm not going to give you anything complex whatsoever.
Okay, pharmaceutical sector?
Some, but not all. So some of the, I wouldn't buy it as a whole. I would look for individual stocks because you're going to see probably some consolidation in that area where some companies are going to be bought out.
Okay, Kendall, how do they access the last 2 webinars that we've done? Are they on protectwealth.com, or how do they get access to them?
Yeah, give us a call. Usually if you are registered for our webinar, so if you're in our system, part of our membership or our Mastermind Academy, you should get the emails coming from us on a consistent basis. As long as you register for those, you're in our system and we'll get the emails Just make sure you register because you'll have the links come usually 24 hours after the webinar has posted. Yeah, give us a call. I put our number there, 800-276-1430. We can help you with that.
Yeah,
Wow,
airlines,
okay.
hospitality, stocks, walk away.
Walk away.
Yeah, anything has to do with service-related industries, I'd walk away at this point in time. They'll start to bounce back, but they'll come back so slow. I'd walk away.
Okay. How would we call you if we didn't register for the last two? Lynn, call us. The numbers there are 800 number for Protect Wealth, or go to our website. There are call us and we'll figure out how to get it to you, Lynn. We're not protective of these at all. We try to get them out to as many people as we can, but we also don't want to blow up your email server by sending emails every day. So give us a call tomorrow during office hours. Any other questions here that you're seeing? Wow.
No. Would you recommend selling QQQ? I probably would between now and the end of the year, because there's going to be, the technology sector will be the better sector, I believe, but I still think it's going to head lower. Right now, we're just getting the oversold bounce, but as soon as the recession numbers kick in, that's where we're going to start to melt back away. So we've had a little bit of bounce. If it was me, I would sell the QQQ at if you have a loss, I'd still sell at a loss, but I think you'll be able to get back in at a better price, I believe, in the future. But I can't tell you that. That's what I would do.
Well, I hope everyone today takes advantage of that $99 special. Oh my gosh, that's an incredible deal. So take advantage of that. And then Mike is a staple speaker at our 3-day summits. Come meet him live and in person. We gave you the dates. They were in Anaheim. Is the next one. It will be in Phoenix. We'll be in Orlando. Later in the year, we'll be in Las Vegas, but don't wait too long. Especially if you're looking for tax savings, legal structures to make money in the market, take advantage of these opportunities when you can. And this is a great opportunity. Mike, thank you for your generosity and your time tonight. So with that, I think we're going to wrap this up. Again, Mike, thank you for being here. And all of you, thank you for spending your evening with us. It's been an incredible webinar. I don't know that we've ever had this many people on a webinar. We're excited to have you. Mike, any closing comments?
No, I just appreciate everybody being here. And if you have any questions for me, first off, go back and watch us, back to Protect Wealth, rewatch this again, guys. It was a great video, lots of information on it, and Don can have some great information there. But I know I talk fast, so you hear it a second time, it'll be better. Other than that, if you have some questions directly, you can email me, mike@incomparator.com. No, I just appreciate being here, and thank you guys for letting me share the information. This is stuff that I just do every day, so it's common knowledge for me, and it's great for me to remember where you guys are as well, so it keeps me where you guys are, so I'm not always thinking where I am, but it helps me communicate better to you and to my friends. So thanks for letting me do this as well.
Great. Everyone, and Kendall, thanks for being in the background. Thank you for all, and we wish you very, very successful trading. Stay safe, everyone out there. We love you. Have a great night.
And cheers right back at you, Will. That's one of my sayings too. Thanks, everybody. Bye-bye.
Bye-bye.